Hello, this is Megan Horniman, the Chief Investment Officer for Verdant's Capital Advisors. We're coming to you today, as we do every January, to offer you a review of our themes that we had for the prior year, also give ourselves a score on those themes, and then outline our themes for the upcoming year, not only from an economic but also an asset class perspective. So let's dig right into our first theme from last year. And this was a soft landing is not a sure thing. We're going to give ourselves an X for this one because we had thought, and many economists did coming into last year, that we would experience at least a short and shallow recession at some point. And that's because the amount of interest rate hikes that the economy had to absorb leading into last year, these were aggressive, and never in history have we been able to absorb that amount of interest rate hikes in such a short period of time and not experienced a recession. Now, fortunately for investors, we didn't get that recession. In fact, growth is going to come in close to 3% for 2024. Our second theme was the Fed is walking a fine line and reflation risk is high. We're going to give ourselves a full check on this one. If you remember at the beginning of the year, many economists had expected that the Fed would cut interest rates as early as March. We thought that was way too optimistic. We took that contrarian view and thought that the Fed, being that inflation was stubborn, wouldn't be able to cut interest rates until the second half of the year. And that's exactly what happened. They cut aggressively in September, and what we're seeing now is that progress on inflation has stalled as the year has ended. Our third theme was fiscal policy, and austerity rhetoric was going to heat up. Well, we're going to give ourselves a full check on this one because there's really no better proof to this than the creation of the Department of Government Efficiency by the Trump administration. This is to try and figure out long-term ways to tackle our deficit problems. The fourth theme was global equities, and the bar is set high. We're going to give ourselves an X for this one. Well, we had anticipated that the global equity, given that valuations were so high and that the Fed wouldn't be able to cut interest rates until the second half of the year, that would be a challenge for specifically U.S. equities. This did not materialize. Actually, U.S. equities did very good, but the U.S. equity market was very concentrated in that Magnificent Seven. If you look at the difference between an S&P 500 market cap index versus an S&P 500 equal cap index, the difference between that performance was over 10% for the year. So it was a very concentrated rally in that mega cap growth names. We did say that we would look for opportunities throughout the year, and we did do that by adding to our international exposure when those valuations looked attractive. Our fifth theme was the unprecedented tug of war for bonds. We're going to give ourselves a full check for this one. We warned about volatility picking up in the Treasury market, specifically because of the amount of supply. There were less buyers from an international and even the Federal Reserve perspective, and we saw that. We saw a lot of sloppy auctions, and we saw a significant increase in volatility in the Treasury market throughout the year. Our last theme was alternatives. Diversification comes in many shapes and sizes. And while we're going to give ourselves a full check on this one, we're very big advocates on that alternative space. However, it's very difficult to look at performance of a illiquid alternative in just a one-year time frame. But what we did warn investors about was look at some of those opportunities from the long term, because volatility in the public markets and valuations in the public markets were expensive. We saw that continue throughout the year. Valuations continued to get expensive specifically in the U.S. equity market, and we saw volatility pick up by 50% for the year. So that deserves a full check as well.